Right, so we're getting into partnerships. Okay, now with partnerships, what happens here, of course, is the fact that and a lot of times, lawyers, doctors, etc., form a partnership. Okay, and of course, the deal is it's a voluntary association. So what it means is two or more people voluntarily band together to form a business. The advantage, of course, is if you're a sole proprietorship, you're limited in the money you can raise to what one person can invest and one person can borrow. But when you form a partnership, suppose you got 2, 3, 4 people, well, then you can have, the resources of 2, 3, 4 people, okay? When you have a partnership, there's something called, well, then you form it with a partnership agreement. And so with the partnership agreement, essentially what it is the best thing to do is to spell out everything that will affect the business, right? You can go down to Powell's and get a fill in the blank, fill out your own. You can do it on a handshake, that'll work. However, here's what Ben Franklin had to say about it. Now, he was in like 26 partnerships, and all of them ended amicably, right? They all went on well. Here's what he said. This is from his autobiography. It's the autobiography of Ben Franklin. So what it says is, my business was now continually augmenting, and my circumstances growing daily easier. My newspaper having become very popular was being for a time almost the only one in this and the neighboring provinces. I experienced too the truth of the observation that after getting the first £100, it is more easy to get the second, money itself being of a really prolific nature. The partnership Carolina having succeeded, I was encouraged to engage in others and to promote several of my workmen who behaved well by establishing them with printing houses in different colonies on the same terms with that in Carolina. Most of them did well, being enabled at the end of our term, 6 years, to purchase the types of me and go on working for themselves, by which means several families were raised. Partnerships often finish in quarrels, but I was happy in this, that mine were all carried on and ended amicably, owing, I think, a good deal to the precaution of having very explicitly settled in our articles everything to be done by or expected from each partner, so that there is nothing to dispute. Which precaution I would therefore recommend to all who enter into partnerships. For whatever esteem partners may have for and confidence in each other at the time of the contract, little jealousies and disgust may arise with ideas of inequity in the care and burden of the business, etc., which are attended often with breach of friendship and connection, perhaps with lawsuits and other disagreeable consequences. So what he's saying is, agree to everything, put it in writing, before you actually open business. And that's the surest way to have a successful partnership. And it's easy to bargain these things before the business starts than when a problem arises. Okay? You can do it on a handshake if you want, but you're better off putting things in writing. It has limited life. Now this is easiest to see if two people go and form a partnership. Two people form a partnership, one becomes incapacitated, there's no partnership, right? Now often what partners do is they take an insurance policy out of each other. And that way, if one dies, the insurance company pays off the heirs, the remaining partner becomes a sole proprietor. That's often how it's done. But just like a sole proprietorship, it has limited life. Taxation is not taxed. What it is the partnership fills out a Form 1034. It's for informational purposes only. It tells the IRS how much each of the partners is claiming of the net income. Okay? That's what they should put in their taxes. It has something called mutual agency. And what this says is any one of the partners acting in the name of the business binds the partnership. So whatever your partner says, buys, sells, whatever, then the whole partnership's obligated. So you've got to be able to trust your partner to use good sense. co-ownership of property. So just like a sole proprietor, when a sole proprietor invests in the business, that money or goods or whatever is owned by the business. Well, the same is true. When each partner invests in the business, after the investment, that is owned by the partnership. Now, each partner has an equity in the partnership, but the asset is actually owned by the partnership. And it is unlimited liability. And so what this says is that each partner is responsible for all the debts of the business. So if two people form a partnership and the partnership goes out of business, each partner is responsible for all the debts of the business. All they got to do is go after one. Okay? All right. There's various kinds of partnerships. There's a limited partnership. And in this, it has at least one general partner. And the general partner has unlimited liability. And can manage. You have limited partners. And they have limited liability, but they can't manage. And it's kind of like it's kind of like a corporation in that the limited partner is an investor, and they invest in the business, but they can't manage. It's similar to buying shares, buying stock in a corporation. You buy stock in a corporation, and your liability is limited to what you have invested. But if you own 1,000 shares of IBM, you have no say-so in the business, right? However, your losses are limited to that 1,000 shares. Okay, that's what a limited partnership is. But there's one general partner who runs the business and has unlimited liability. There's limited liability limited liability partnerships. Okay. Now, by the way, this is an LP. This is an LLP. Now, what this is, it insures against malpractice. So suppose two doctors form a limited liability partnership. One of the doctors screws up and is charged with malpractice. Well, the malpractice affects only that one partner, but they are responsible, each partner is responsible for the debts of the business. Limited to one partner. However, all partners responsible for debts. Okay, so if one of the doctors malpractices, that doctor is subject to the malpractice suit. Okay, however, all the partners are equally responsible for all the debts of the business. Okay, all right, and then you have a limited liability company. Now, this was a limited liability company up until maybe 5 years ago, and now it's a limited liability corporation. It's the same type of business. And this has the limited liability of a corporation, but it's taxed like a partnership. Okay. So what happened here was, so it's limited liability company, right?
What do
Yeah.
you have written?
I'm sorry, what?
What do you have written?
What does that say?
Yeah.
This?
Yeah.
Well, it has the limited liability of a corporation, right? But it's taxed like a partnership. And of course, remember when a corporation has the double taxation in it? Okay, well, this is taxed one time. Okay, so with, yeah, is everybody familiar with the double taxation? Okay, however, a limited liability company, you have the protection. Now, a couple of things. What's unique about the limited liability company is it's a relatively new form of business. How you doing there, Gene? Is there still a mysterious
I can't word? see.
Well, could you, just standing up help?
Not really. I can't read it.
What's that?
I can't read it.
Oh, you mean that it's illegible?
Yeah.
Listen, read. All right, limited liability corporation, okay?
Okay.
All right, and then it's taxed like a partnership? Okay, all right. And thanks, okay,
Thank you.
all right. I'll slow down. Okay. Okay, all right. All right. Good. Everybody else doing good? All right. Good. All right. So let's do this. So the thing about this is so a lot of time, a lot of books would have included this under corporation because they see it as a form of corporation, not a partnership. The reason I think, of course, Wilde put it here is because it's it replaces partnerships. The thing about it is it's a relatively new thing, less than 10 years old, 15, whatever. So if you have a sole proprietorship or a regular partnership, and you go to your attorney and say, if I do this, what'll happen? Well, there's hundreds of years of case law, and your attorney says, this is what'll happen. If you go in with this limited liability company, because it's so new, asking the same question, he or she may not know, just because it doesn't have that body of case law. Okay, so it's relatively new. And then, of course, it's somewhat complex. So they have the limited liability of a corporation. However, it's taxed one time as personal tax. It's taxed as though it's similar to a partnership, where you pass a certain portion of the income on to each owner, and they declare that in their 1040 pay taxes on the quarter. Okay. All right. Now, let's go ahead and organize a partnership. Don't forget, almost everything, most things that you learn on how to do a sole proprietorship will apply to a partnership. The only difference is there's more than one capital account. There's a capital account for each partner, and there's a withdrawal account for each partner. Other than that, it's pretty much the same. So let's go ahead and have an example here. So Zane and Hector form a partnership. Zane, Hector form a partnership. Okay? So Zane invests $7,000 cash. $33,000 in merchandise, in facilities. Now, Gene, this is still getting illegible, isn't it?
A little.
A little, all right.
Sorry.
Let me slow, no, I appreciate that. We'll make you the, what do they call it, a lightning rod or bellwether or something. There isn't a name for a person who,
Whistleblower?
canary in the coal mine. There's a name for that, right? Whistleblower, canary. There's a name for that. What is it, bellwether, indicator? There's a name.
Weather vane.
The what?
The weather vane.
The weather vane. Yeah, the weather vane.
The
All right,
beacon.
we'll call you the weather vane. You tell which way the wind's blowing? There's got to be another name for that. The tripwire. All right. All right. Well, listen. So, Zane invested $7,000 cash, $7,000 in facilities. You're right. It is $33,000. Was that you, Mariah? Okay. By the way, did you guys know Mariah is Miss Clark County?
Oh, you
Nice
won.
job.
Yeah, congratulations.
Yeah. So, we're kind of like among royalty, I suppose, is the way you want to word it, right? All right, well, congratulations.
Thank you.
Okay, nice job. All right, and a $10,000 note, okay? All right. Where Perez, well, let's make this Perez instead of Hector.
I like that anyway.
Thank you. All right.
So hold
He invests 10,000 in cash, okay? So here's what it looks like. So on January 11th is when they form the partnership. So you're going to debit cash for 7,000. You're going, boarding facilities is this one, so facilities. That's an account name, okay, is debited for 33,000. You have a note payable of 10,000. That means that 30,000 will be Zane Common Capital. Okay, so now the partnership owns this cash, owns this facility, and has assumed this liability. And this is how much equity Zane has in the partnership. And this is January 11th. And then on January 11th, we'll take it, so now we have cash will be debited for 10,000. And Perez, comma, capital will be credited for 10,000. And so this is the initial investment in the business, okay? Is that a hand up?
Yeah.
All right.
Okay, so Zane invested 40,000 total with 7,000 cash and 33 facilities. Why is Zane's capital only 30,000?
Because these facilities came with a $10,000 note.
Okay, so then 23,000 would be the part, or that portion of the capital, and then 7,000 cash, okay? Okay.
Yeah. And so the equity that he has in the business is 30,000. Because it would really be a $23,000.
Okay.
Yeah. Okay. All right. Any other questions? All right. Okay, let's do this. Let's see. How should I do this? This is kind of, excuse me just a second, make sure I don't step in here. I'm going to turn this over here. And let's get into dividing up the income. Okay. Now, what we're doing on this next thing is, let me kind of lay it out schematically. Okay. So what's happening here is that, do you remember when we had a sole proprietorship? You had revenue. So this is closing. You have revenue, you have expense, you have income summary, and then you have your capital. And then you close the revenue to income summary, you close the expense to income summary, then you close the net income to capital. And you also close the withdrawals. Okay? So when you closed, and it was a sole proprietorship, right? You closed the revenue to income summary, you closed the expense to income summary, that gave you the net income, and then you closed that net income or net loss to the capital account. You also closed the withdrawals to the capital account. You guys remember that?
Yeah.
Now, we're going to do the same thing, but what's a little different is the fact that there'll be more than one capital account. There'll be more than one capital account. You know, in a way I should word that, there'll be a capital account for each partner. Maybe a better way of wording it. But I don't think I write that down so we can move along. Okay, but there'll be a capital, so there'll be more than one capital account, be one for each partner, right? And when you divvy it up on this basis. It's as though they have a salary or a return on their investment. Okay, or stated ratio. So it's important to realize here is the fact that when they use the words on the salary basis, there's not actually a salary. They're saying is, let's divvy this net income as though these people were receiving a salary, and that'll compensate them for putting in their time. Yeah,
So the split starts at net income.
the split starts at net income,
Okay.
exactly. And here's how they make the split.
Okay.
They divvy it up as though they were receiving a salary, as though they were receiving a return on their investment, or maybe just a stated ratio, okay? Now, they don't really receive a salary, because that would be an expense, and it's not here, it's here. Okay, so it's not here. It's a return on their investment, that would also be an expense, but it doesn't occur here, it occurs here. So they divide it up as though they were a salary, as though it was a return on their investment, or perhaps a stated ratio. Okay? But it's so important to realize we're not talking about a salary expense, we're not talking about a interest expense, etc. We're just dividing it up among the various capital accounts this way. Okay? Yeah.
You said earlier they have their own withdrawal accounts?
And they all have their, everybody, each partner has their own capital account and their own corresponding withdrawal account.
And
Okay?
how does that affect their, whatever they're getting, their return on investment?
Well, actually, this one doesn't, okay? So what happens here is you get the net income, right? And part of that net income is transferred to each capital account, okay? And then each capital account has their withdrawals, and that will give the ending balance in each capital account, okay? And then this is the basis for dividing this net income up between or among, depending on whether there's two or more capital accounts. It's done on this basis. So for instance, what you can have here is one person can put in the money, another person can put in the time. So if that's the case, the person who put in the time will receive the equivalent of a salary, $50,000 a year. The person who put in all the money will receive a 10% return, as though they received a 10% return on the investment. What's left over is divided equally. So the person who put in the money gets a return, gets part of it as though it were a return on an investment. The person who puts in all the time will get something as though it were a salary. And then what's left over of the net income that's not accounted for these two is divided equally, for instance. Does that make sense?
Mm-hmm.
Now, with that introduction, let's kind of go into this. So let's start with, so in this case, the partnership agreement says that Zane will take 2/3 of the net income, and Perez will get 1/3. Okay? And the net income is $60,000. Well, 2/3 of 60 is 40. So the way that works is, so on December 31st, they do the closing. When you do the closing, income summary will be debited for $60,000. Because if it's a net income, right, if it's a net income, then that means it has a credit balance of $60,000. Does that sound about right? Okay. And then you have Zane, comma, capital. Now Zane gets 2/3 of the net income, so Zane will get 40. And then you have Perez, comma, capital. He gets 1/3, he or she gets 1/3, and 1/3 of 60 is 20. So what you're doing is you're getting the net income, you're transferring it to the capital accounts on the basis of a stated ratio. In this case, this is what they agreed to in their partnership agreement. Right.
That's the step of getting rid of the interest rate.
Yeah, it could be getting rid of, what I would say, it transfers the net income, because what the income summary does now is it finds the net income or net loss.
Yes.
And then, the next step in the closing process, after you find the net income or net loss, is to transfer the capital. Now, last time, there was one capital account as a sole proprietorship, now it's two capital accounts, and so this net income is then transferred. Okay? And this is what's called stated ratio. Now, if the partnership agreement is silent as to the ratio, it's divided equally. Okay? So if the partnership agreement is silent, and I'm going to make that more legible for Jean says something. And it's, Jean, this is meant kindly, it is okay if I kid you, right?
Yeah.
Because it is meant kindly, so if it feels anything else, give a yell. I won't say it anymore. Because I do appreciate your input, because, okay. The partnership agreement, silent, divide equally. Okay. Now, so in this case, the partnership agreement said 2/3 and 1/3, right? So that's what we did. Whatever the partnership agreement says, that's what you do. If the partnership agreement says nothing about it, then you divide equally. Now, how do you know this? Where did this come from? Like on high? Well, there's a thing called the Uniform Partnership Act. And the Uniform Partnership Act is adopted by almost all the states. And the Uniform Partnership Act, which is adopted by it's adopted by the states. It says that if nothing's said about how to divide up the net income, it's divided equally. Now, this uniform partnership is adopted by almost all the states. There is some variation among states. For instance, Louisiana didn't adopt it. And the reason is because Louisiana, their history and much of their state law is based on French law, and the rest of us are based on English law. And I guess they're very different. I guess, one thing that English law has is we're all innocent until proven guilty. That's where we got it. French law doesn't have that concept. Okay, and I'm not sure how it works. I don't know if you have to prove your innocence or what the deal is, but all I mean to say is there's some real fundamental differences in the two. So, but most states follow the Uniform Partnership Act, and that's where it says, if nothing's said about how to divide up is equal. Okay?
Question.
Yeah, all right. Now, here's another way of doing it. You can also do it allocation on capital balances. Now, what will happen is we'll go through this stated ratio, etc., and then at some point in time, we'll show you how they can be linked together. So here we have Zane, okay? And Zane has 30,000 invested, right? Okay? And Perez has 10,000 invested. So the total equity is 40,000. Okay? Now, what this says, so now, 30 over 40 is 75%. 10 over 40 is 25%. Okay? So see where I'm getting 75%?
Yeah.
So it's 30 over 40, so the total equity is 40. 30 belongs to Zane, so this is 3/4, 1/4. And then we multiply that times the 60,000. And so Zane, under these circumstances, would get 45,000, and Perez would get 15,000, added together, and the full 60,000 is accounted for. So, in this case, it's divided up according to the capital balances. So it's allocated on the capital balances. Here's the capital balances, here's the total capital. And because Zane has 3/4 of it, he or she gets 3/4 of the net income. Perez has 1/4, so Perez gets 1/4. Okay? All right. Now, what happens here is, let's kind of go on to another one. So now let's link them together. So now what we're going to do is we're going to divide this net income. So we divided it up by a stated ratio based on the capital balances. Now, let's link them together where it's done in both. So what happens here now is the net income is 70,000 in this example. Okay? And the partnership agreement, so here we have Zane. And Jean, did you notice how sometimes they spell Zane differently?
Yeah.
Okay, that's good. Yeah, yeah. So I just thought, yeah, okay. All right. And it just keeps people on their toes, okay? Because people are thinking, anyway, so listen, here's the deal, and there's the net income. So this particular partnership agreement says, listen, Zane puts in more time than Perez. So we'll say that he gets 36,000 as though it's a salary, and Perez will get 24,000 as though it were a salary, and this leaves 10,000 left. Okay? So, and again, all it's, and for Zane just puts in more time. Okay? So we're going to first dividing it up as though it were a salary. Then they get an interest, 10%. So 10% of the 30,000 is 3,000. 10% of the 10,000 is 1,000. Now this means that there's 6,000 left, and then the remainder is divided equally. So half of this is 3,000, half of that is 3,000, and 6,000. So now there's none left. And I think I'll just leave that blank, or maybe put a 0. There's none left. Okay. Now, what happened here is, so the total credit to Zane's capital account will be 36,000 plus 3 plus 3. So his or her account will be credited with 42,000. 24 plus 1 plus 3. So Perez's account will be credited for 28. And so here you have the $70,000 net income. It's divided up in this manner, that everybody gets, each of them get, each of them get a salary. Because Zane puts in more time, he gets a greater salary. Okay, and it's not an expense, right? It's not an expense, but rather it's an agreed way to divvy up the net income. Then they get a return of 10% on their investment. Okay, 10% of 30,000, 10% of 10,000. And what's left over is then divided equally. Okay? So this will be a credit to Zane, capital, credit to Perez, capital. Yeah, Mariah.
I'm sorry, I must have missed this. Where did the 3,000 and 1,000 come from? Were those given? Or
They were, what the contract says is that here's the salaries, everybody gets a 10% return on their investment,
Okay.
and then what's left over is divided equally, and that's just what the contract says.
I missed the from the investment. I thought it was from the 36,000.
No, it's for the it's investment. And again, what happens, so what they're doing here is, the way this is set up, they're rewarding for time put in, they're rewarding for investments, is how it's set up, which seems fair to me. Okay. All right. Now, so let's do this. Now let's do another one very similar. So in this case, instead of having a $70,000 net income, let's say the agreement said the same thing. The agreement said each of the people get this salaries, each get a 10% return on investment, what's left over is divided equally, right? Now, suppose instead of a net income of 70, let's say we have a net income of 50. Okay, so now, first there's the salary. And so it's 36 and 24. Just as it was before. Okay, so now there's a deficit of 10. Okay,